focus yesterday, I guess, was on the views from the agriculture sector, and our first session this morning probably turns that around a little bit and starts to look at the issue of investment in agriculture from the perspective of the investors. So in other words, those that might be interested in agriculture, what they're looking for, or what are factors that make their decisions. So we've got three speakers this morning who I think will give us some very interesting insights into that particular issue. Our first is David Williams. David's the Managing Director of the investment bank Kidder Williams Limited, which specialises in mergers and acquisitions in agriculture, food and beverages. His PhD research at the University of Sydney was on optimal capital structures for cooperatives. So when he went into investment banking in '84, his first role was to advise on the merger of SPC and Ardmona. Since then, he advised the majority of Australia's agricultural cooperatives when he has not been conflicted. He's advised many of Australia's largest food and agricultural companies, including Incitec Pivot, Australian Wheat Board, CSR, New Farm, SPC, Tassal, Select Harvest, Bega Cheese, Buller and many multinationals. He's also been an advisor to farmer groups such as the VFF and the Queensland Grain Growers Association and various governments on the privatisation of a lot of the statutory marketing authorities. He's not just an advisor, he's prepared to back himself. He bought the bankrupt salmon producer Tassal in 2003 from its bankers, and he has refinanced the company and listed it on the stock exchange, turning it around and merging it with his closest competitor, and Tassal is now capitalised at 600 million. So he's certainly got a track record, and I think the common phrase yesterday was skin in the game. So please welcome this morning David Williams from Kidder Williams.
Thank you, Mick. I haven't got a formal presentation. I thought I'd just have a chat, and I thought I'd start off by talking about, who are these investors in agriculture and food in Australia, because I think it's probably important to know, if you want to know what it is that they want and what they think about Australian food and agriculture, then you better know who they are to start with. I thought that might be an interesting place to kick off. One of the things that's sort of upsetting me at the moment is with this sort of proliferation of conferences on Asia, the Food Bowl, and China, the Food Bowl, at the federal level, at the state level, it seems there's no week goes by without a conference on the topic. And out of it is coming a lot of platitudes from so-called captains of industry and ministers of agriculture on what you need to do. Along the lines of, I read on Friday some chairman of a public company saying that you ought to get out there and grasp China. Get out and don't let this get you by. Don't let it pass you by. The money's out there, grab it. And I thought to myself, well, if I jumped on a plane and I went to Shanghai, who is it that I'm actually going to grab? This whole sort of rhetoric about get out there and grab yourself a Chinaman. What does that mean? It sounds like there's guys sitting on mattresses full of money over in China just waiting for your call, to pump it right into you. And I'm sort of a bit upset by it because it's not clear to me that there's one sort of amorphous mass of investors, and we're dealing with them every day, given that we've got a dozen to sort of 15 acquisitions or divestitures going on at any one time. And the fact of the matter is that over the last 10 years, and certainly over the last 5 years, the complexion of the buyer universe and the investor universe has changed unbelievably. There are people now investing, there are people now in the market who didn't even exist 5 years ago, and some that didn't even exist 10 years ago. And I'm talking about PE firms, I'm talking about sovereign funds, I'm talking about ag and food focused funds of various sorts, and I'm talking about trade buyers who 5 years ago had no interest in going offshore from wherever they come from, and certainly not coming to Australia. So it's not clear to me when you say to people, get out there and make something of it, what that actually means, because I don't think most people can action it, and most people I find are not aware of how deep and interesting that sort of bio-universe is now compared with what it was even 5 years ago. So I think that's worth talking about just for a second, because unless you understand who they are, you won't understand what they're looking for, and they're all looking for something different, as I'll sort of just give you some anecdotes as we go through. So if you look at what happened, for example, by contrast in the wine industry over the last 20 years, the wine industry has done roughly what the politicians and these captains of industry are asking you to do now about the Chinese and about other foreign investors. In other words, the wine industry expanded quite dramatically, and the wine makers themselves, even the smallest guys who are doing 2,000 cases, 3,000 cases, 5,000 cases, did get off their asses. And when they went on holiday to Bali, they went to every restaurant they could find, every bottle shop they could find, every distributor they could find. And so now it's pretty hard to go anywhere in the world and not find a bottle of Casella Yellowtail or a bottle of Yering Station or a bottle of Scotchman's Hill. They've done a fantastic job, sorting out all of those trade buyers, if you like, and distributors and so on and so forth. But those buyers and those investors for a product like wine are still there. But what's changed is that there's a whole lot of other people who have come into the market to invest in food and ag who weren't there 5 years ago, weren't there 10 years ago. And those people have got very different incentives and very different costs of capital and rates of return on investment criteria than the trade buyers. And oftentimes they can outbid them and outbid them significantly because of those differences. So it's important to sort of understand the distinction. So I'll give you an example. We recently sold Tasman meats to JBS in Brazil. It's the largest multi-species abattoir in the country. Its price is just sub 200. And in the normal course of selling a business like that or looking for an investor like that, we would sit down with our team and we'd have a whiteboard and the client, and in about an hour or 2 hours we could come up with probably 50 or 60% of the buyer universe. So you go through all the normal suspects, Smithfield Meat, Harbig, JBS, Cargill's, Nippon Meat, etc., etc. And if you did a couple of days' work on it, you'd probably have 90% of the buyer universe. It turns out that when you put a business like that up for sale at the moment, and even a small business, only $200 million, a small business like that, it turns out that the top 10 bids, in the top 10 bids, 5 of them were from people not in the meat industry. 1 of them was from the wealthiest man in Russia, 2 of them were PE firms, and 3 of them were governments. Now, if you sat down with a white sheet of paper, in this whole room, if we sat down with a white sheet of paper, who would buy the largest multi-species abattoir in Australia? Well, you wouldn't come up with Abramovich, for example. You wouldn't come up with the Brunei government, for example. These people didn't exist in this sort of bio-universe 10 years ago. So I'm going to come back in a minute to what they sort of want and why they're different and how they look at assets differently and what's driving them and so forth. But the interesting thing is that even if you took the rhetoric about how you get to these, but get out and get one of them, get yourself an Abramovich right now, even if you could, how do you actually get to them? How do you identify them? Because the universe is so deep that you can't get to them by just sitting down with a white piece of paper. So when you talk to somebody like Abramovich, he says this to you. This is the guy that owns Chelsea Football Club, by the way. So if he owns Chelsea Football Club, why not a meat business in Australia is what I would say. But why didn't I think of that, for Christ's sake? Dumbass, So he says to you this, listen. We didn't actually say listen, I think it's David. I tell you what about Putin. But yeah, this is what he says. Listen, I'm very close with Putin. I was at his daughter's wedding, but things are fragile in Russia. Who knows what will happen tomorrow? So it's for me, it's a portfolio approach. Get some money offshore, get it into big assets. I don't need to know anything about meat. If I need to, I could bring meat into Russia. That's fine, but I don't need to. All I want to do is make sure that I've got my assets sort of covered offshore. And when you go up to China now, if you go and talk to some of the immigration consultants there or here, and you'll find hundreds of people willing to come into Australia or other places for that matter, who've put a circle around $30 to $40 million to spend. These are people, largely, some, not all of them, but many of them are wanting to move assets offshore for a whole lot of reasons that would be obvious to everybody about political fragility and so on and so forth. And these are people that, if you put a circle around $30 or $40 million, these are people who are not coming here to buy a $250,000 flat in Parramatta. Right? They're looking for houses of $3 million, $5 million. They're looking for small wineries. They're looking for small businesses. But around that sort of 5 to 10 level. And when you look at what, say, happened in the wine industry, just to close that circle, in the last year, 2 years, in the last year alone, there would have been 20 wineries in this country sold to Chinese buyers, all sort of sub $5 million, and all essentially trophy assets, half of them. But the other half, some guy who owns a pipe factory in northern China or a plastics factory in southern China, goes, I wouldn't mind a property in Australia. I've got to get some money offshore. And I know a lot of people in China. We like red wine. I can bring it in. And some of those things have been outstanding successes and others of them have been complete failures. But from an Australian perspective, who gives a rat's? Take the money, spend it, and get on with your life. And the good thing from an Australian perspective is they'll put not only that money into the Australian economy, but they'll put it into further capital expenditure, and that can only be good. So a lot of these people, by the way, whether you're talking at the Abramovich end or you're talking at about a small investor end where they're only talking about $5 million, these people have very low rates of return. The primary incentive is to get money offshore. And so we've had a number of assets in recent times where the highest bidder by a long way has been in this sort of category. The question is, when you're trying to run a quick process, can you wait for them to actually get their money out? And can you trust that you're going to actually get completion? So there's a whole lot of issues about execution that you need to sort of think about. But in the main, these people have shown that they've got very low rates of return, but they are slow to act, and because of the circumstances of why they're trying to get money out, sometimes they're coming out of jurisdictions where it's not that easy to get it out tomorrow. They don't just transfer it around like we do. So, coming back to Tasman Meats then. So, here's a bio-universe that you sort of couldn't even get to. Now, the question is, where do all these people come from? Well, the Abramoviches of the world, we understand. The sovereign funds and the SOEs, the likes of GIC out of Singapore, CIC out of China, QIF out of Qatar, Oman Investment Trust, PAC Brunei. Most people have never heard of these ones. Before I even go into Northern Europe and Latin America and Northern Canada and so forth. We've got a whole lot of endowment funds that sort of overlay on top of that, who've got another set of incentives. The weight of superannuation money now is forcing the superannuation funds to go not only wider afield, but to try and match their books with the sort of profile of the investments they've got under their control. So we've seen in this market very active superannuation fund money coming out of Harvard University, out of Canadian Teachers Fund, out of teachers' funds in Norway, and so on and so forth. A whole lot of names that most people would never have heard of, and I only say that because I hadn't heard of most of them. And so we've got a very rich market there. And then you've got a whole bunch of people who have got funds that are to do with agriculture in particular, and sometimes very specific agriculture, like New Forest, like Westchester, like Hancock Timber, etc., etc. And then a whole bunch of private equity funds, many of whom were not there 5 years ago either. Enya Knudsen, who just took 20% in Ridley, Payne and Partners out of Chicago with Kevin Schwartz, who just took 50% of Costa Group, etc., etc. So trying to get to where this universe is a job in itself, which I sort of won't bore you with just for the moment. But it's pretty obvious when you start to look at them that they all, and when you have to work with them, that they've got all very different criteria for what they're trying to achieve, and therefore what you need to offer them, but also in terms of rates of return. So the sort of interest we're now getting out of China from some of the bigger Chinese funds is showing me that there's plenty of money around just north of 5% rates of return. Now, you compare that with a trade buyer that's listed on the Australian Stock Exchange and who has to make, who's trading at a PE of 16 or 10 or 8, where the market mainly is, 10 to 12, they need to make returns of like 15% minimum. You go to the PE funds and they're looking for 20, 25% and 3-year exits. So some of this Chinese money at 5 to 6% is very attractive if you can get your hands on it, if you can go and bag yourself a Chinaman, as it were. I think we've got a sort of a perfect storm here, because you can't pick up a paper without blaming this whole interest in food and agriculture in Australia on the Chinese. But the perfect storm really comes from the fact that there's a whole group of people over here that are like Abramovich or like a lot of the Chinese people trying to get money offshore, and it's across the board. This market used to be dominated by the property market in London and Paris. Problems in Greece, I'm shitting myself, get my money out of Greece and put it into a property in Soho. That's how it worked. Nowadays, that universe has gone to Australia, it's gone to many countries around the world. But that's the sort of market, that's a silo of people which is now very hot. You've got another silo of people that are based on superannuation funds, long-dated returns, green assets, stable assets like timber and so forth. And then you've got a whole lot of other people that are interested in food and agriculture because of food price inflation, population increases and changes in wealth. And that's driving a whole lot of interest with trade buyers, and it's driving a whole lot of interest with SOEs and with governments in themselves. Let me just dwell on that for a minute before I come back to drilling down into what people really want and how they're treating with people like us on the investment side. First of all, on the population side. Let's just be really clear on what it's all about. In the world, in 1800, the population was 1 billion. In 1930, it had gone to 2 billion. It took 130 years to get there. By 1963, it was 3 billion. It took another 33 years. By 1977, it took 14 years, it was 4 billion. And by 1989, it was 5 billion. It took 12 years. Are you getting the picture? So you've got the FAO forecast now, this much vaunted figure of 9 billion people in the world by 2050. But at the rate that you can see historically what's happened, we could easily get there. That's people need to be fed. And they need to be fed from what is a decreasing amount of arable land, decreasing because of urbanisation, decreasing because of land degradation, and decreasing because people like the nutty US have been subsidising biofuels and taking land up for fuels. And scarce water. So that's the problem in that. At the same time, you've got massive increases in wealth. So let's just take China, but China's just a small microcosm of that. If you take a typical urban Chinese, in 2000, his average salary was $760 a year. Today, it's $3,000. In 1985, the consumption per head of beef in China was 15 kilos a head. Today, it's 55. In Hong Kong, it's 110. Not only is that, you've got to look at the flow-on effects of that. So, 1 kilo of beef, 8 kilo of grain, shitload of water, etc., etc. Now, the problem's more serious than that, because when you get into this food thing, when people's income increases, as Barry Irvin said yesterday, we're not supplying the poor, we're supplying the rich. Because when a guy in China's income goes from $760 to $3,000, he doesn't want to eat more rice. He wants to eat what the Australian Embassy's eating. He wants to eat what the UN FAO meetings are eating. They want foie gras and frog legs and Chateau Lafite and cognac and Chateau Yquem and so forth. So it's interesting because your calories only go from 2,000 to 2,500, but the spend on income, quality of food goes up like 700%. Now, all that's great, fantastic, except if food prices go up astronomically, all these people that you've dragged up from $760 to $3,000 a head per income get pushed back into poverty. So some people can't get food at all, and other people getting pushed back down again. And so if you look at the FAO Food Index, between 1970 and 2007, it bumped along at about 145. This is a sort of basket of its food commodities. And then in 2000, in fact, it went down slightly in real terms over that nearly 40-year period. In 2008, in June 2008, before the Lehman crash in September, the index jumps from 145 to 225. It blipped again then in 210, but since 2011, it's been hovering around 245. And if you look at the basket of commodities, the 16 commodities that are traded on international commodity exchanges, every one except lumber is currently traded about 150, 170 times, percent times its 10-year average. In other words, population growth, increases in wealth, they're leading to a sea change in prices. And of course, what happens then in 2008 and 2011, when you see these big spikes, and now you see food riots in Haiti, you see food riots in various parts of Africa, because some of these people can't afford food any longer. So that's why governments are interested. That's why sovereign funds are interested. Not necessarily always to get the food, by the way, but that's why they're interested in food security and food price inflation, because it's a social need that needs to be accommodated. So if you just take China, for example, the sovereign fund in China is CIC, China Investment Corp, and everybody knows, I suppose you read the paper, that they've been looking at VDL, the Woolnorth property down in northwest Tasmania. These guys don't necessarily want product. They're not trade buyers. They're not coming here like a Bega Cheese comes or a Murray Goulburn. They're not or a Mitsubishi or a Toshu or whatever. They don't come and necessarily want to make an investment to get product. They want to hitch their wagon to this whole sort of perfect storm of food price security and food price inflation. So when somebody like CIC comes, they only want 49%, they don't want 51%, they don't want any product, they don't want anybody on the board of directors. So this is a very interesting type of investor, if you like. This is a very different person to try and sell something to Barry Irvin, for example. And very different rates of return. So let's just talk about the Chinese just for a moment. First of all, despite all the rhetoric that comes out of the politicians in this country, we're not alone out there. Anybody who's dealt with the Chinese knows this. They can send over 6 people, 8 people, 10 people, and they'll say, yeah, I like the business, I'll come back to you next week. And you ring next week, and one of the guys is in the Ukraine, and one of them's in Nigeria, and trying to get to these guys with all of their opportunity costs is a nightmare in and of itself. They tend to be, on top of that, very big tyre kickers. So they've got a back room of 50 analysts, and they're collecting every flyer they can get, and they're analysing it to death. But the number of deals they do versus the number of deals they look at is minuscule. So you need to be careful to read the tea leaves correctly. Second thing is they have very low rates of return, as I've just said, and you can point to me examples, say like the Newcastle port last week where China Merchant Groups paid $800 million for its share, and say, well, that was done at above 20 times EBITDA. It was. But when you know the numbers in some detail, that return looks more like 6% because it's guaranteed increases in port fees and so on and so forth. So you don't always have to look at the headline numbers. Thirdly, they hardly ever come with advisors. So you've got to be very prepared in terms of how you're going to present to the Chinese. So a typical entourage might be 6 to 8 people. It'll include 5 guys who've got MBAs from Wharton and NYU and Stanford and so forth. Language is imperfect. Strategy is often imperfect, even though they might have analysed the numbers together and to death. But very difficult to deal with if you don't have advisors. So we're now in the sort of mindset of saying to Chinese visitors, listen, don't come unless you've got an advisor. We want to see a legal advisor, we want to see an accounting advisor, we want to see an investment banking advisor. Otherwise, we suspect you might be wasting our time and your time. And it slows down the process. There's no advisor-to-advisor communication, no lawyer-to-lawyer communication, and so on and so forth. So, got to be very careful of that. Thirdly, there's a cultural issue, lots of cultural issues, but this whole getting to know you takes a lot of time, so there's no quick deals with the Chinese. It takes a long time to have lots of drinks and meals and make sure that they trust and know your bona fides and vice versa. And so, the sales process for people like us slows right down if you've got a Chinese company involved. Of course, you can't sell anything these days without having a Chinese company involved, whether they're there or not. I like to refer to them as Casper the Friendly Ghost. You know, you sort of pump the rumour into the market anyway, just to make it look like there's a lot more interest. But oftentimes, they're not really there. So the interesting thing about the Chinese is this, that you can't pick up a paper today, you can't pick up a paper any week in this country without seeing the word dairy and China in the same sentence. That's what the whole thing is about. Infant formula, growing up powders, nutritional powders, etc., etc. It's a massive, and has been a massive growth area in dairy. But when you think about it, the Chinese have done SFA in dairy, right? The acquisitions and the target work and consolidation work that's been done in this country in the last 2 years has been done by the New Zealanders with Fonterra. It's been done by Chobani out of New York. It's been done by Saputo out of Canada. It's been done by Lactalis out of France. We've got Parmalat here, and it's been done a lot by the Japanese. Otoshu into Burra Foods, Mitsubishi into MG's New Dryer in Tasmania, etc., etc. Where are the bloody Chinese? Grab me my Chinaman. So that just shows you the market is growing like buggery in China, but the Chinese aren't there. They have been there. They've kicked a few tyres. Don't worry about that. But they can't react in the same way as Bega reacts on Warrnambool or Saputo acted on Warrnambool. You know, Bega acts one day, Warrnambool's got a bid in 2 weeks. You're still waiting for the Chinese to get on a plane in Shanghai, you know. So they're very slow to react, and sometimes the rhetoric is much greater than what the reality is. Now, the Chinese, as I said before with my example on CIC, have a whole lot of different interests. So there's CIC trying to hitch its wagon to food and ag investment. On the other hand, you've got a whole range of reasons for why people want to be in the market. So you've got guys that are in it because they want product, whether that be sugar or wheat or whatever. And you've got guys who just want to learn. So you've got Bright Foods, for example, bought Manassan. It's a distributor of fine foods. What are they going to do? Bring soy sauce in and plug it into supermarkets? That's not a business, you know. So, you know, in that case, you've got Bright Foods using Manassan to say, okay, we've got certain problems back in China in terms of distribution networks and how we get, you know, wholesale products in. Let's buy the business. Let's see how it runs. Let's use the management there to give us some advice on how we can sort of replicate that into China. And you're seeing a lot of that at the moment about using the business as a learning curve for how we're going to reshape our position in China. Then you've got a whole bunch of people who just want trophy assets. So I was sitting with a client of mine the other day in a restaurant. He's got a big property down in the Western District. He's been in the market for 3 years. He's about 20% over the market, so the agent tells him he hadn't had one offer, not one offer. And as I'm there, the elders guy rings up and he says, I've sold your property. He said, why didn't you ring me? He said, well, I sold it above what you asked for, and that was above what the market was. He said, I had these 3 guys in the car. One was in the front, 2 were in the back. They were asleep, and we're driving through the paddocks, and suddenly 3 kangaroos jumped out of a bush, and the front one goes, oh, look, kangaroos. They go, shit, buy the property. That's it. We can bring our clients. You know, small beers, 5 million, 6 million, you know, nothing. So they've got this whole group of guys, I said, are interested in trophy assets, sometimes just to have it, sometimes to bring people, sometimes to take the product off. Which also raises the question that the Chinese, more than a lot of other buyers we see, are interested in the connection between the farm and the processor. And so you can see people looking, for example, at an MG dryer in Smithton, and they're saying, yeah, that's great, I'm happy to buy into that, but you know what, where am I going to get the milk from? They go, well, that's not a bad question, but you know, we've got to buy some farms as well. So you're seeing up and down the chain a lot of interest in, you know, buying, especially in a Chinese mindset anyway, trying to buy into this connection between the farm and the processor. You're seeing some of the opposite, by the way, as well. So if you look at Olam, who bought all the Timbercorp assets in the almonds, and they bought Queensland cotton, you know, they've just now trying to divest most of that. So they've sold all the almond land, and all they want is the product. They go, you know what, I don't need a balance sheet heavy with this sort of stuff. I see plenty of funds around the world, super funds and so forth, who are happy to buy that on a yield of 7%. I'm going to get that out the door, take all my capital off the table, and I've got what I wanted in the first place anyway, which is just product. That's all I want. So what? That's all I want to say. Thank you for having me.